Well, we're seeing already slowdown in China, and for years and years, people have been investing based on the idea that China's GDP growth would continue at an extraordinary pace. We saw endowments creating entire sleeves for emerging market investments, basically built on the idea of China. And we've seen commodities become a very, very attractive place to invest, as people thought that continued industrialization in China, that this was going to happen forever. And a lot of what we're seeing now is a bit of an unwinding of that. China in particular is facing major issues in how they're going to grow their economy. Their new 5-year plan is focused on creating new consumers in China, which means lifting labor costs, which means slowing this industrialization. So we have deep concerns that one of the big underpinnings for this commodity argument, that there will be ever expanding demand, has been pulled out. We see austerity in developed markets, and now in emerging markets we're starting to see a China that no longer can support the kind of extraordinary hyperactive development that has led to the kind of growth rates they've seen. So for us, we're concerned that commodity pricing is going to continue to fall because demand isn't going to be there.
And I think it's important to point out that a number of commodity stocks have discounted this, that there's going to be a growing, slowing growth in demand from China, that over the past 5 years, the stocks of the big commodity companies like Vale, Barrick Gold are down over 50% in price. They're looking into the future and seeing the slowing growth coming. We've taken the position that there's much better ways to invest in the growth of resources around the world. And it's really through value-added companies, companies that play on the commodity theme, but have technology and other parts of their company that allow them to earn premium returns off the commodity boom.
A lot of people assumed that you could simply buy the commodity and rely on commodity prices to rise over time. And that created an entire network of investors that decided they were simply going to bet on the continuing rise of commodity prices. The companies that we're talking about are real operating companies that develop cash. They do well when commodity prices are high, but they are not wholly reliant on an ever-rising price in commodities. So we look today and see commodities across the board almost as being well more expensive than they were 10 or 12 years ago. And we feel that those high prices are not yet fully discounting the slow growth world we're going to be in going forward. Developed economies in austerity and a Chinese economy that has a lot of significant challenges ahead.